Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello Chris, good to see you again.
Hello Lee, good to be here, refreshed from my summer break.
Yeah, we had a little bit of a break, didn't we? While you went off and enjoyed a little bit of relaxation. Maybe not relaxation.
I need a rest now. It was quite a lot of sport, great fun. Yeah, and decent sunshine in the UK, in the east of England. Someone asked for more, so yeah, great stuff. Thoroughly enjoyable. And it's been a pretty quiet time for the stock market and many of the companies we follow. And the market itself has been hanging on a sort of thread, waiting for the news that we're going to discuss shortly.
Yeah. What I found really interesting when I said to you, did you enjoy your holiday? Welcome back. You said, oh, yeah, straight back into no broadband and profit warnings. So I found that really
that was a real joy. I thought that was a real joy. No broadband is still pretty essential. This was at least at home. Office was all right, but no home broadband. Brought great joy. And an hour-long call with the broadband providers to get them to have a look at it, which was also delightful. And then of course, we have profit warnings. So we have nice summer, nice and calm, and bang, first day back, we have a few profit warnings. Some from companies we, as in Fundamental, our associated business, hold shares in, which was a bit annoying.
Yeah, which we are going to touch on, which I'm really interested to hear how you handled that and what you did and your process and thinking as well. It'd be interesting to hear that. But as you mentioned there, the first company I'm going to go into is Nvidia. Just released results, didn't they? And seemed pretty nice.
Oh, unbelievable. But unbelievable isn't good enough. I mean, revenue was up 100, this is quarter on quarter, 122%, so quarter compared to prior year's quarter. 122% quarterly revenue to 30 billion, ahead of forecast of 28.7. So it's a big beat ahead of forecast. That's 15% up on the prior quarter. Earnings per share up 152%, 68 cents. It's the superlatives to go on with this. Gross margin 75%. Operating margin 62%. This business is incredible. But as beating the numbers isn't enough, as one commentator mentioned, the market expects them to shatter forecasts. And that wasn't the case here. But yeah, truly incredible how this business has been growing and is seemingly set to continue growing. But that's not enough. The market wants more, so the shares were down a little bit. And what's really staggering with Nvidia now is it's dominating the headlines. It's like the market used to view the non-farm payroll numbers or the CPI numbers. It's that kind of barometer. The whole market is hanging on this business. It's such a core part of the growth, the AI story. And quite frankly, if you want exposure to AI, you need to know further than Nvidia. It is the core of it and the place to be. But yeah, it is somewhat worrying, probably, that we're all so focused on this one stock. Nearly unprecedented. I do remember actually back in the dot-com era when everybody was hanging on Cisco's numbers. Cisco was a key provider, routers and everything. And so that was the key barometer. And that was actually often viewed as a trigger when Cisco started missing for the big sell-off and the bursting of the dot-com bubble. But yeah, Nvidia is just huge. It's also, I've never known a company in such an early stage of its growth profile, this staggering, announce extending its share buyback program, $50 billion share buyback program. You'd think it would be needing the resources and the cash to grow, but this thing has got excess amounts of the stuff, and it's now wanting to return it to shareholders, which is phenomenal.
Does it concern you that this could actually be bubble territory, things like that?
It does, yeah.
Yeah.
It's this, when something is all encompassing and all investors' attention is just focused on a single stock, really. I know we've got the Microsofts and Alphabets and Metas, but this thing is garnering most of the attention. And a lot of other companies, AI-related companies, are hanging on it as well. Yeah, it is worrying. And yet, look, the valuation based on shortish term growth, a year or 2 years out, doesn't look too bad. It's got to keep this going now for 3, 5, 10 years. And a colleague has written an article that Investors Champions published. It should be out when this podcast is released on our thinking around Nvidia in terms of valuation and its positioning. AI at the moment, ChatGPT, there's a lot of fun in it, isn't it? It's helping creative industries a bit. But where are we going to find the really useful applications, the applications in maybe pharmaceutical, drug development, research. That's where the real benefit's going to start coming through, maybe robotics. We're not anywhere near that at the moment. So there is huge potential, but let's get beyond the fun and see how it can really be deployed. And hopefully Nvidia is going to be really part of it. There are lots of others getting into the AI game. There are lots of private equity funded ones as well, VC funded ones. And Microsoft is deploying it as well. They're a big buyer, and all these rivals, the applications that are being developed are developing their own, trying to develop their own chipsets as well.
Yeah.
So they're going to be rivals creeping into this space. But yeah, Nvidia at the moment is head and shoulders above everybody else, and it's embedded everybody into it through its software platform as well. That's the key. It's not just the chips; it's the software platform as well that's sort of binding everybody to their ecosystem.
Yeah, you can't argue with the brilliant success of the company, and well done to Nvidia and the team there. It's fantastic. Could do with more companies like that in other
Oh
verticals, don't
yeah,
we?
I mean,
Not just in the AI space. I do also worry that from an innovation standpoint, where else is there that type of innovation going on other than the AI? It would be nice to see it in multiple different
yeah,
verticals, wouldn't it?
it's got lost, doesn't it, at the
It
moment
has a
in
little
the
bit. I think
AI
so.
obsession. Yeah, I
It's
agree. I
yeah,
agree. Yeah,
we're now funneling perhaps maybe the best minds, all the money into a
yeah.
very narrow, concentrated space. But yeah, I think this is
No, you're
pro.
right. You're right. That has been lost, and there's a lot of VC money now going into the AI space.
Yeah.
Has that been taken from other worthwhile areas? And some of these areas where they need much more funding, it's hard. Realistically, it's hard for them to compete. Even the
Of
big
course it
tech
is.
groups. I mean,
Yeah.
you've just heard here that Nvidia's going to spend $50 billion on a share buyback. Doesn't need it for its own investment. You've got Alphabet, Microsoft, and Meta all doing the same thing. Massive sums of money. How can a small provider without the cash flow effectively compete? It's hard to see.
It's a challenge, isn't it?
Yeah, it
Yeah.
is. It is.
Shall we move on to a person who did create quite a significant investment in various different companies and has done very well out of it?
Yeah,
Uh,
this is another great story. This one,
this
isn't
is a
it?
great story, and there's a few lessons in this, isn't there, as well, for many of the investors in there. Berkshire Hathaway, Warren Buffett just crossed $1 trillion. That's amazing, isn't it?
Yeah, amazing. A
Is it the
$1 trillion
first
values.
non-tech company to cross $1 trillion? Is it?
Yeah, first non-tech company cost $1 trillion, and who would have
There you
thought it'd be
go.
Berkshire Hathaway? But it's a business that some people gave up on a few. They thought Warren had missed a trick, but the whole group seems to be firing on all cylinders. $1 trillion. He turns 94, probably it's tomorrow, and when this podcast goes out, it'll be 94 years of age.
Even that is an achievement, isn't it?
It's unbelievable. He took over the company in 1965 when its market value was $25 million.
Wow.
And the key point is it's the largest US company based on shareholder equity. So this is its capital base is $602 billion. So its capital plus its retained earnings have grown to $602 billion. And he's grown it effectively all organically
So
by
what does that mean? So when you say it's the largest company per shareholder,
so that's its capital base relative. It's not its market capitalization. It's the issued share capital plus the retained earnings in simple form
yeah,
is now over $600 billion. So a lot of companies don't have those kind of retained earnings. But Buffett has, and Munger, his late partner who
mm,
died this year or the end of last year, has grown this business really by using internally generated cash flow
right,
and modest amounts of debt. Effectively, they got a debt because of the insurance operations, but they're collecting insurance premiums, which ultimately they could be needing to pay out. But really, the other amazing thing I found absolutely incredible about this, if you look at the numbers, is this is from 1965 up to the present day. The share count hasn't climbed very much. They haven't issued many new shares, and on occasions they've undertaken share buybacks. So the share count is when Warren Buffett took over this business, or took over the running of it in 1965, 1.1 million shares were outstanding. Yeah, they had 1
yeah.
million shares in issue. Now they've only grown to 1.4 million. Find me another business where that's happened. Most companies' share count would have gone up considerably, especially a highly acquisitive business like this that's made countless acquisitions. Nowhere else would you find that kind of limited amount of share issuance. This factors in these B class shares. So if you consolidate them, you get to 1.4 million shares. So the share count's up 30% over 60 years. The market cap has gone from 25 million to 1 trillion. The A shares are now trading for what? Just shy of $700,000 each?
Wow.
$700,000 a share. It was interesting. One commentator read pointed out that median sale price of a home in the US is 439,000. So one share of Berkshire Hathaway. It's a really fantastic story.
It's incredible, isn't it? If your dad had bought you a share when you're 1 year old, oh,
Yeah.
sorry, 3 shares, wasn't it, in
Yeah, that's right.
1960,
Yeah.
1965 for
Yeah.
$56, 3 shares, which I suppose back in 1965, $56 would have
It's
been
quite a lot of money, probably.
quite a lot of
Yeah.
money,
Yeah.
but it'd be worth 2.1 million today.
Yeah. Yeah. Not bad, is it?
Yeah,
Do nothing, just holding on to it. I question whether anybody could have held on to it and not maybe sold one or two on that journey.
yeah,
But after a while, you'd have looked at your $56 and thought, "Hey, this is getting a bit pricey."
yeah.
Probably, but a lot did. This is the real key message here. And a lot of people held their faith in Buffett, didn't they?
I guess it goes back to that patience, isn't it? Believing in the founder, believing in the vision, believing in what they're saying and what they're doing and watching them, analyzing them. And yeah, these individuals, whatever company you may be following, they're actually doing what they're saying and
Yeah.
holding your nerve with them.
And he's got a very effective way of communicating.
He's very good at communicating,
Yeah.
isn't he?
Which engendered a lot of loyalty
Yeah.
and patience. So as a result, a lot of their early shareholders, some of them are billionaires, just by saying, "No, I'll stick with Warren."
Yeah.
Warren and Charlie are doing a good job. I like what they say. They're simple. The message is simple. I'll stick with them.
Just to expand a little bit on Berkshire Hathaway,
Yeah.
they're essentially a holding company. Would that be a fair comment?
Yeah, it is. Yeah, yeah. Yeah.
Yeah. So Berkshire Hathaway is essentially a holding company. What sort of companies do they identify? What sort of companies do they like to have in their portfolio? And how do they then turn that company into what has become an unbelievable collection of companies?
Effectively, there are two distinct pots to it. There are businesses that they own outright, which they're operating companies, which therefore they in their results they're consolidated and they're reported in the operating income. The likes of their insurance groups, Geico, Burlington or Santa Fe, the railroad companies, See's Candy, a business they've owned for countless years, very smaller business. But there are loads of companies they own outright and they consolidate. And aside from that, they've got their, you could say, passive investment stakes, of which Apple's their largest holding, multi-hundred billions of dollars of holding, whereas they cut it in half. Bank of America was another big stock that they also that has also reduced their holding in recently. But yeah, no, so they've got huge passive investment stakes, some of which have been around for a long time, and they've got these active operating companies. And all of this is funded. The key in the operating model is what I've mentioned, is their insurance float. So their insurance businesses are collecting premiums all the time, providing a float, which can be redeployed in supporting some of their investments as well. Most recently, Berkshire has decided to sell out of some of its holdings. It's reduced its stake in Apple, as I said, reduced its stake in Bank of America. So its cash holdings and cash and treasuries has grown to a pretty big pile of just under $300 billion. So this business is sitting pretty, really. If the market does sell off, valuations look more attractive in the US, they'll come in and start nipping up some good deals. Clearly, if things keep going for the Apples and Bank of Americas, they're not as well positioned. But then again, they've already made massive gains on them. It's still huge gains. So why not take a bit off the table? But the insurance float has been key. And whilst there's talk of Berkshire not employing too much leverage and gearing, that's effectively what the insurance business gives you. It's collecting lots and lots of premiums, which effectively could be payable. Clearly, a lot of them won't, but there is a potential contingent there. And in the interim, they're using that float to make all these other investments. It's been a great story and a practically unique model. And
Yeah.
that share count piece is absolutely key. So many acquisitive businesses go about issuing loads and loads of new stock to do deals. Buffett and Munger jealously guard their shares. They don't want to issue new shares that will dilute their own interests. It'll dilute the interests of their existing holders. They jealously guard them. They will only issue new shares if it's absolutely essential and start buying them back if they think the shares are cheap. And that is so different from other businesses. There's this lack of concept of shareholder return and return for your existing shareholder base.
Great story. Be nice to see more of it, wouldn't it?
Oh yeah, it'd be great. Be great. Yeah. And that way of communicating as well. Seemingly a great deal of honesty, which
Yeah,
is
and
clearly gone down well, isn't it?
And then we've touched on this previously, haven't we, in many of our podcasts, that we do feel the London Stock Exchange and the companies that the constitutes of the London Stock Exchange, they do struggle with communication, don't they, and presenting themselves.
Yeah.
Whereas you look at, as we've just said there, Warren Buffett, Berkshire Hathaway definitely doesn't. Then you got Apple, Steve Jobs, even Tim Cook, I
Yeah.
think, does a great job.
Oh yeah, excellent. They do. They're great communicators. And one thing you don't see out of Berkshire Hathaway is the term EBITDA ever.
Yeah,
Charlie Munger was pretty vocal in his view of the term EBITDA, but you don't see that. Why don't others learn from that? It's not as if they haven't done a load of deals. This company's been a deal machine.
yeah, it's true. Yeah, absolutely. Perhaps there's not just lessons for us, the investors, but there's lessons for the companies in there, isn't there?
Yeah, I think so. I think they could learn a lot from that
Yeah.
business.
Should we move on to the small cap now? Small cap
Yeah,
news.
yeah, that would be good. Yeah, as I said, we were greeted with a few profit warnings. A business we fundamental owned for a while. That's a personal favorite, really. It was at one time. It's testing our patience the most. Called Focusrite, a music and audio products group. Its headquarters isn't far from our offices. I've been to see them. They put out a profit warning. Times are still tough for their largest division, which is difficult. What they do, they've been an acquirer of businesses. Again, they didn't time some of the acquisitions very well. A lot of the acquisitions have been made out of internally generated cash flow. Cash flow is strong, but yeah, they've been facing a whole load of problems. They were going great guns over the pandemic. Everything was great. Everybody was producing stuff at home, in need of their kits and happy to pay for it. Clearly, you've had an excessive sort of stock in the channel, as they say, and that's hurt their content creation business. They've had logistics and shipping problems, but yeah, it's been a tricky one. We've had to think long and hard over this one. It's not the business that we originally bought into, and we have been starting to lose patience. But I still believe there's a growing portfolio of products. I like the model of shoving more and more products into this group and be able to put those into its distribution channel. I like that. And seemingly, as cash flows improved, as debt has come down, they'll be able to deploy more in niche acquisitions, and hopefully those will be a bit cheaper as well. And I think, look, its content creation division should pick up as well. We're sticking with it for now, but it has been a bit of a millstone, and we've seen the shares fall precipitously over the last few years.
What would you like to see the change in their trajectory for them, apart from the
Well,
share price rising?
yeah, I'd like to see the content creation division start to tick up and demonstrate the growth that we saw previously. That's easier said than done.
When you say the content creation, what do you mean by that?
So these are products that help people create content, music, particularly music. You've got the synthesizers in there as well.
So
You've
these are
got
products that help people at
audio.
home create music, create
Yeah,
video, etc. Primarily music.
yeah, and that's been really a bit of a problem. The audio reproduction piece has been better. They provide a lot of kit for outside events. That was clearly hurt in the pandemic and lockdown when these weren't going on. That's come back strongly, where the others declined. Unfortunately, audio reproduction is a lot smaller than content creation, so you're getting a bit bigger whack. The other slight concern with this business, they've got to sort of run very fast, simply to stand still. There's lots of investment in new products, and they've got to launch new products. Hopefully they resonate with the public, and you've got to encourage your customer to trade up and move to a higher product, to the next version. That's quite tough, especially when the consumer's feeling it a little bit. So yeah, it hasn't been ideal, but there's a nice little business there, and hopefully it can add more of these niche products into its group, which would be quite interesting.
Do you see that being one of the key drivers of kind of turning this business around?
I do. Acquisitions has always been part of it. This is an acquisition story. If it would have just been the Focus brand, it wouldn't have been that interesting. You'd have had too much volatility. Hopefully, when you have a broader product set and a fewer booming and lesser flatlining, overall you can move forward. You're never going to have probably everything humming at the same
Yeah,
time
yeah.
when you've got lots of different products, but some can benefit from those real boosts, short-term boosts. And the more you have, the better it'll be. But you've got to acquire cleverly. You've got to acquire at the right price. You've got to acquire without issuing too many new shares, of which we discussed with Berkshire Hathaway, out of internally generated cash flow. That's
Mhm.
key. Let's see how they do it.
I was just thinking there as well. What would it take for you to say that's enough? That's the line in the sand, or is that too difficult a question to answer because there could be
Well,
extenuating
I,
sort of
I, I'm
circumstances?
I'm getting close at the
You're getting
moment.
close.
Is there a future? Is there a future? Are we never ever going to see the pandemic style returns that we had? I think this is very different from another business that we're going to cover later, where they had a one-off pandemic boost. But yeah, I don't know. The jury's out at the moment.
Yeah, so it's very much a watch and see and see how it
Yeah,
goes.
This isn't a perfect science. You've got to take a decision
Uh,
sometime.
yeah, that's investing though, isn't it? It's not a
Yeah,
perfect science, is it?
no.
So the next company, which you're actually a personal shareholder of, isn't it? Aquis Exchange.
Yeah, I like this business. We'd like to buy it for the firm as well, but the shares are pretty illiquid. Been to see that it's been tough to buy. We've bought a few accounts, but the shares are so illiquid. It calls itself a facilitator of next generation financial markets. It's got a sort of rival to AIM, which is a small part of its business. Its technology bit, where it licenses exchange related technology to clients around the world, looks really interesting. It's now saying it's going to invest more in that, which is going to impact profits. It's also said it's a big contract isn't being renewed with one big contract, a reasonably sized contract with one client isn't going to be renewed. It's not that material. It's a startup exchange. But yeah, I quite like what it's trying to do. Rival to the LSE, huge market, to the LSE, London Stock Exchange Group, that is. And it's interesting. It's highly profitable, decent margins. Growth is slowed a bit. It's fighting against the big boys. It's got a CEO, founder CEO that's done it before and knows the space. Yeah, I like it. I just wish the shares were more liquid because we quite like to buy across our client book for this, but it's just tough to acquire the shares. It's got a lot of loyal shareholders.
How can it become a rival to LSE? Because most people
Well,
probably,
it's more on the technology space that it could rival larger exchanges. It's got a technology offering that appeals. So yeah, it's never going to rival to that extent,
hmm,
but it's in that space, and it's conceivably can take business from it. A cheaper alternative based on a subscription model, conceivably it can be a nuisance, and it has been gaining traction, as they say. But yeah, it's not easy when you're up against big
yeah.
incumbents like that.
What would it take for it to become a bonkers bargain or a stonking small cap on the investors champion? Is it?
The stonking small cap, the growth would have to be a lot better.
Yeah.
Its growth is flatlined, or it's not single digit. You're looking for double digit typically
Yeah.
with our stonking small cap, and it's not in bonkers bargain territory yet because it's
Yeah.
trading multiple. The shares, that's the slight issue now. It's now forecasting a more moderate growth, yet the multiple now is trading at 20 odd times forecast earnings, which conceivably looks quite rich, although it's full of cash, so it's got plenty of cash. But yeah, 3.5% revenue growth is not, I wouldn't call stonking small cap. It's sort of moderated a bit over the last few months.
But you like the business model.
I like it. I like what the founders are trying to do. I think it's interesting.
Yeah.
It's
Yeah.
unusual as well. It's unusual play on AIM.
Brilliant. The next company we're going to move on to, Naked Wines. This is perhaps a business model that I'm not so keen on.
I think this is bonkers and all the other reasons. I
Not a
feel
bonkers bargain.
no, I feel sorry for it, really. The guys running it, what a tough job. Online
Yeah.
wine retail. They've just announced results. Sales fell 18% to 200, says 290 million of sales, and the statutory loss before tax was 16 million. Last year, the loss was 15 million. The only time this business has ever approached making money is in the pandemic, when everybody was stuck at home buying things online. Subsequently, it costs far too much money to acquire customers. And the other issue this company's had, even the returning chairman's admittances, it's got too much capital tied up in inventory. So it's got
Yeah.
it holds loads and loads of stocks of wine, modestly priced wine, and the world's awash with modestly priced wine. 132 million of inventory on sales of 290. You're tying up a lot of capital. I struggle, unfortunately, to see the way out. The valuations dropped to circa 40 odd million market cap, which doesn't look much for it hasn't demonstrated it consistently make money. And there's little, as I've commented, to distinguish one modestly priced Sauvignon Blanc from another. It hasn't got really any brand strengths or anything. It does its best. It works incredibly hard. Marketing's quite slick, but having lured a customer in, having spent a lot of money on advertising, the customer just isn't necessarily going to go away. Oh, sorry, it is tempted to leave pretty quickly or not repurchase because it'll be its customers tempted from all sorts of other angles.
What do you think as well about the angel fund as well? That
Yeah, 68 million effectively of cash sitting in its books that it's been advanced, that has been paid in by its so-called angels.
mm,
These are subscribers that pay pay money in consistently, notionally to help support emerging winemakers. That's really money that's due to the subscribers. If all of them said, no, we've had enough, we want out, they'd be heavily indebted. So they're not in a net cash position. They're really in a net debt position. And I can't believe, and I've mentioned this on several occasions, why these balances aren't ring fenced, why they can be commingled with the company's cash and be considered in similar terms to the company's cash. I think it's totally wrong. Virgin Wines does ring fence them, and they distinguish their subscribers' advances to their own cash. So yeah, it's not very clean from my perspective, and another sort of black mark on the model itself. But yeah, I struggle to really see a way out, and good luck to management. If they can work this one through, they've done a heck of a job, because it looks a really tricky space to make profits, online wine retail.
Yeah, so one to watch out for, but perhaps not maybe in the same way of Aquis Exchange.
Yeah.
Shall we finish off with H&T Group then? This is something that Fundamental does own, and it's in the Investors Champion portfolio as well.
Yeah, we own it in both our AIM portfolios, in our income one, our growth one. It's a pawnbroker and jewellery retailer and foreign currency provider. I like the pawnbroking business model. We've got another one, Ramsden's as well, which is bigger in foreign currency. But H&T Group, it sweats its shops to great effect. Does really well, and it's just announced interim results. Profit before tax up 12.5% to 9.9 million. All of the group's divisions are contributing. The pawnbroking pledge book, which has been a key growth driver, that's grown a lot as well. Everything's been seemingly doing well, and also strong gold price. This business really benefits from the strong gold price, and it's been doing nicely out of that. So yeah, it's firing on all cylinders really, with the exception that people that it's lent to have been redeeming their pledges earlier than previously. And it's as a result of that, really, that's triggered a sort of downgrade. So despite all these positives, the house broker has cut forecast by 11% for the current year and 13% for next year. That looks somewhat harsh in the context of what appears to be a relatively short-term move, especially when they say management has said that redemptions have normalized, and albeit later than anticipated. So the commentary around this suggests it was relatively short term, but now there have been a host of downgrades put through on longer term numbers. I don't know if that's management guiding down to help manage expectations. It might be a bit of it, so they can. But this business has experienced several downgrades over recent months. And it's all frustrating, but notwithstanding that the shares look cracking value and could continue to do nicely, especially in a more stressed consumer environment where there are a few other options for people.
Yeah, I found it really interesting, this one, because profits before tax were up 12.5%. The pawnbroking pledge book increased to 105 million from 101 million. Retail jewellery and watch sales rose 27%.
Fantastic, that, isn't it?
Yeah. And foreign currency profits rose 10%. So it's like everything just looks great.
Yeah.
But yeah, as you mentioned, it's subsequent downgrades.
Yeah.
I found it quite an odd one myself.
Yeah, it is. And it's not as if earnings are still growing as well. From the numbers you've just quoted, this should be one of our stonking small caps.
Stonking small cap.
I mean, it's double-digit growth across most of its product lines.
Yeah.
Find me maybe another jeweler growing at 27%. That's not bad, is it?
Yeah.
Yeah, it's all pretty good news. You get a lovely dividend yield with this as well, just shy of 5% dividend yield, trading at 7.7 times forecast earnings, which forecast still to tick up healthily. But yeah, what the suggestions are now, that growth's going to be tougher than anticipated. Is the excuse really fair? Is it just about these earlier redemptions? Is there something else there that's caused management to guide forecast lower? I don't know.
Yeah. Again, it's not an exact science key, is it? So
Not at all. Not at all.
Time will tell. To me, this was a real broad range of such different companies, from the Nvidias to the Naked Wines to Berkshire Hathaway and Warren Buffett and the amazing success that he's delivered, and then down to H&T Group, which by all the numbers there looks a fantastic little company.
It looks a nice little business. And it has been quite a range, hasn't it?
It has been a real range.
Something for everyone.
Hopefully something for everyone. So we are back now, aren't we, Chris? We'll be back next week, and we'll be back for the foreseeable, perhaps maybe a break over Christmas. I'm sure many will understand that.
And hopefully no more profit warnings. Or
Fingers
if they
crossed.
they're mild ones.
Fingers crossed. And we do hope as well, all these companies that are UK-centric, they do succeed. We don't want to see them go.
No, I hope Naked Wine succeeds.
Absolutely.
It looks going to be a tough one.
It's the challenge, isn't it?
Yeah.
Brilliant, Chris. Thank you very much.
Thanks very much.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.